So the other kind of aspect to share prices is so we covered global economy, we covered internal things. Sometimes share prices are higher than like the book value of the company because people see enormous room for growth. And we're really talking tech stocks here. That's something that happens a lot with them. Um, so, for example, Amazon. Right now, we looked it up this morning. Its PE was 462 this morning, correct?
Yeah, I think that's what we saw. I mean, that's a pretty big PE.
That's huge. That's so much. Like, what's a typical one for a bank? Like 18 or something?
Yeah, I think the S&P 500. I think the average PE ratio on the S&P 500 right now is like 20 or 21.
Right. And of course, like things vary by industry, but 462 is high regardless of what industry you're in. But a lot of people see a lot of potential in Amazon, so they're willing to pay a premium for those stocks despite there not being like the present perhaps value for them.
Right, and just to clarify one thing, it's not so much that the stocks, their market capitalization are higher than their book value. It's really what we're talking about here is you're on a continuum in terms of what you're paying for a stock. And what your PE ratio tells you, this is the way you can kind of think about it. If your PE ratio is 20, that means you're paying $20 for every $1 of current earnings in that company, right? So if your PE ratio is 5, then you're paying $5 for every single dollar. So the higher the PE ratio, the more speculative the stock. And in Amazon's case, right, Amazon isn't, it's not like Amazon is a speculative company, right? I mean, we were talking about this before. I mean, like, Gabby, you buy on Amazon, I'm sure all the time. I buy on Amazon all the time. The issue with Amazon is that their success and their growth and their revenue is not reflected in their bottom line, because what Bezos does, and Bezos has got to be, I mean, like, on the short list of best CEOs in the country, and this is one of the reasons, is that he is taking all of that money they're earning and he's recycling that back into growth. And that's why it's not hitting the bottom line, and that's why their PE ratio is so high.
Yeah. But yes, you're absolutely right. Sorry, I kind of like transitioned into the next thing without acknowledging the fact that you're super right on that.
Did I put you to sleep?
No, I was actually thinking of another tech stock, which kind of highlights the risk, perhaps would be the right word, which is GoPro. When it first went public, its PE was insane. Shares are super expensive, and I have it pulled up on my screen right now. They're currently trading at $11.13 a share, and their PE is 9.12. So that's one of the things that you do sometimes see with these companies with these huge PE values, or with that seem to have like be a little bit in terms of stock price overvalued. Is that sometimes they do go down. That is a danger with these.
Yeah, and the other thing that I think that's a great example. I'm glad you brought the PE ratio up, because what that also shows us is that, in a case like GoPro versus an Amazon, there is much more going on behind the PE ratio. So yes, the PE ratio is a good entry to get an idea of what's going on, but then you really got to look at, what's beyond that. In Amazon's case, it's cash flow. In GoPro's case, it's probably, I would say how I would couch that is that their problem is that they are over reliant on a single type of product that they're selling.